Morning, Jamie Kyte.
Good morning, Mark.
Nice to see you. This is our third studio in 3 podcasts, I think. So yeah, we got the mood lighting right this time, though. So we're very on brand. I guess for those that don't know you, it'd be great if you could just introduce yourself, and then we'll just get into a conversation on what on earth is going on.
Yeah. So my name is Jamie Kyte. I'm a chartered financial planner at Buckingham Gate. I've been doing financial planning now for over 10 years, and I work with families and individuals to make sure essentially that they've got enough money for the rest of their lives, and then along the way making sure they're doing all the right things from a tax efficiency basis, investing basis, estate planning basis, and we cover everything together.
So I've wound you up for the last few years because I've said you've got the easiest job with interest rates at practically zero and have been for the last decade. Equities have been the only game in town. And all of a sudden that seems to have changed really, and things are going on. So what's your current state of play with stock markets that may or may not continue to go up, and is there something else that people can be doing?
You know what I think the long term, it is very hard to time markets, and long term, I think the play is a proper portfolio of global equities. And when I say global, all different types of regions, all different types of classes of equities, whether it's energy, tech, whatever it is, it's about having that overall blend so that you can weather the storm, and also if a certain sector does go down in value, you're also protected by the other sector. Okay. And we were talking recently about how tech sold off at the beginning of the year, and that was replaced by energy and banks going up. And that, I think that's the key, having a proper portfolio that has everything in it.
Yeah, I mean, we can't argue with that, I guess. And if you're playing the long game, 10, 20 years, any chart really does tell you that that's the way. Though it was always tempting, and I'm probably more guilty of this, of giving you a call and saying, right, now's the time to get out of something and into something else. But patience is a virtue.
What do you get into? I guess if you pull out of equities, you're either mostly going into, let's call it, the main asset classes being property, bonds, and cash. Cash is still, yes, interest rates are rising, but you're still not going to be getting anything in cash. Property, I guess if you're pulling money out of equities, are you just going to chuck it into a property? No. Bonds, with rising interest rates, do you want to be in bonds? Probably not. I think it's the only way to go.
Yeah. And I guess the other thing at the moment, that's obviously interest rates are rising as a response to inflation, and interest rates aren't rising anywhere near as fast as inflation is. You must be getting a load of phone calls now about how do I protect myself against this?
Yeah. Well, I guess for individuals, that normally where you get hit when interest rates go up are people's mortgages. So mortgage rates are going to go up. And I think short term, are people going to be leaving money in the bank to get the interest that the banks are offering? Probably not. No. I think interest rates, they're going to have to rate. They are going to raise interest rates to try and combat inflation. The problem is that inflation is not going to come down straight away. I don't think so, and therefore people are going to have to fight with rising inflation and rising interest rates. And I think people are they're going to feel the squeeze. People are already feeling the squeeze. I said to you recently, I think lower income households and also people that are entering retirement, they're going to feel that the most. They're going to feel that inflation squeeze, whereas people with, let's say, middle to high incomes, they're still going to be taking advantage of low interest rates. They're going to have excess income to do stuff with, and I think they won't feel the pinch as hard. I don't know what you can do. I think that from a personal perspective, and also I think it's just keeping an eye on stuff like bills, like doing the right thing, making sure that you're on the right contracts, whether it's, I don't know, energy, gas, electricity, whatever it is, because that's you can't do anything about that.
Yeah,
really.
Yeah, you're still going to have to consume it.
Yeah, and those are the essentials. Like people are, I mean, yeah, people still want to turn on the lights. People still need to heat their houses, flats. So I don't know what you can. Yeah,
you made a point there that it was pensioners that would feel this as well. Just explain that point, if you would.
So when I say pensioners, I mean pensioners that are going to rely on what we call a money purchase, like a personal pension to live off that, because they're going to be drawing down money from that pension to live their lifestyle. And they're going to have to draw down money at a quicker rate than they probably thought they were going to do, because they were, expecting inflation over the long run of not something like, 5, 6, 7%. So they're going to have to pull out money quicker. If there is then a downturn in markets at the same time, you're pulling out money from a portfolio that's going down in value. And if you're taking out money at a faster rate in a portfolio that is being level or going down in value, it becomes a lot harder for that portfolio to recover.
Yep.
Whereas if you're not pulling out money and you ride it out and then it increases in value, it's nowhere near as bad.
Sure. Yeah, that makes sense. I guess, again, coming back to the sort of the market side of things as well, are you seeing people trying to be more selective in what they're purchasing because we've seen such volatility? You know, we talked about tech and, you know, the switch into energy. Are people trying to be more selective? I know there's a big thing in retail stocks now, but as a portfolio and a managed portfolio?
I'm not seeing it.
No. Okay.
And the kind of portfolios that we run is like we're not making big plays on that. We're just in the market. I think the important thing with a properly managed portfolio is that it's rebalanced at the right time. So let's say there is a sell-off in tech and there is some growth in the oil and energy market and the banking market, then it's important to rebalance that portfolio so that when tech does recover, if it does recover, which I'm sure it will, you get that growth in that side of the market.
Sure. What about alternative assets? And obviously, you know, I'm going crypto and NFTs and buzzwords that seem to be gaining traction. I mean, we're seeing banks start to take them seriously now. Are you getting interest from your customers in looking at this as an asset class? And if you are, what do you say to them?
So yes, there is interest, and yes, more and more clients are asking about it. I cannot advise on. No, I can't advise on those asset classes. Have I got some of those asset classes? As you know, I do, and I think it's an interesting space. I think, like with anything, you need to invest for a purpose. There's no point in just putting money into something and not thinking about when you're going to need that money. Like if someone's put money into the crypto market and they've taken a punt on it, and a month or two later it's down 30, 40%, which has happened constantly over, let's say, a 3 to 5 year cycle at some point. If they need that money at that point then, and they need to pull it out, that's the wrong thing to be doing. You need to, I guess you need to be in it for the long term. You need to be able to ride out these 30 to 40% moves. So I guess that's what I'd say to my clients. Think about when you're going to need that money and what's it going to be used for.
Yeah, that makes sense. And what about the future of crypto? Have you worked out what the purpose is for it as yet?
So I've got an NFT or two. I think it serves a purpose there in order to own a digital asset on the blockchain. Mm-hmm. I can see it using a purpose there. You can buy it, and I've always bought art, and I like buying art, and I've done that for, I don't know, over 10 years as well. I guess, over to you. Like, I don't know, what are people using Bitcoin for? Have you ever used Bitcoin to buy? Do you know anyone that's used Bitcoin to purchase something?
No. So I know an investment, and that's about it. I mean, I think I can see the future. I think everything is finding its feet. And an NFT of a 16-bit, image is largely irrelevant in the long term, because what we're doing there is working out what a digital asset is and trying to find a value for it. And then digital assets will evolve and become much more encompassing, and then all of a sudden it becomes a real viable product. And these are just the baby steps into it. But 1,000 odd cryptocurrencies, and choosing the right one, it just seems like the .com bubble of the 90s.
Yeah, but people have been saying that for a long time now, and they're still going.
Absolutely, yeah. If you've been saying it for the last 5 years, you probably would have missed 1,000+% of upside in these. And I'm saying that as someone that's missed 1,000+% of upside in these. So.
Yeah, I remember when I was in America for a wedding, must have been 4 years ago or so, and they were going mad about it then in America, and like everyone was raving about it, getting into it, not knowing quite what it was going to be used for, and the market's flown since then. But I don't know I don't know where we've got to from there. I don't know if it's being used for anything else than what was being used back then.
Yeah,
I don't know.
Absolutely, and I guess we'll find out at some point when someone like an Apple comes in. Tesla tried, but obviously with Mr. Musk, it's a slightly different proposition, isn't it? And I'm sure he's just trading his personal account with every tweet that he makes going out there. But no, it would be an interesting space to watch.
It is an interesting space. I think the NFT non-fungible token space is a really interesting space. Like how people are building communities on the back of these digital assets. part of me skeptical about it. Part of me thinks people are just pumping up these non-fungible token NFT markets to make a quick buck. A lot of them, they don't exist. They get launched, and then a week or two later, they're just worth nothing. And people have invested however many thousands of dollars and pounds, and then they're worth zero.
And obviously that money's gone somewhere, straight into the pocket of the creator.
Yeah.
Yeah.
But I guess, is it any different to investing in an artist and then the artist doesn't go anywhere? It's probably not too different, like putting money into an art project or buying a canvas, and then the artist just says, you know what, I'm not doing this anymore.
Sure. So it's, again, I guess your point of, if you need the money, if you're going to need the money at some point, don't do it. If it's investing for the long term and you've got a belief in it, then
yeah, it's a punt. I still think it's a punt to a certain extent. Nobody knows where it's going to go. It's got a very short track record. When you're looking at equities and bonds, you know what they've been doing for over 100 years, and you understand how a company works, what makes a company profitable. I guess it's not too dissimilar. Like what makes commodities you're taking a punt on where the market's going to go.
Yeah,
and who knows where it's going to go.
Well, absolutely. I mean, we're talking now, and we're sort of 8-9 days into what is a terrible war, and things are going crazy, and it just feels, we were saying as we were walking in here, that what we were going to talk about, coming out of COVID and all of the sort of support and getting back to work, is almost feels like a distant memory now, doesn't it? So I guess you've got that long term, but what's happening in the short term seems so unpredictable. If you're thinking about unpredictability, and are you naturally quite risk averse in the job that you do at times like this?
In what way?
Well, I mean, it would just be easy if we look at the markets, equities are, melting down, albeit slowly.
Yeah.
Everything's running into the dollar. Gold is obviously high, and energy is just going nuts. Do you just sit on the sidelines and try and play a defensive part of this, or do you go, well, actually, there's opportunity here?
I think with a well diversified portfolio, it's like what you get. The answer is just stay in the markets. I think nobody is extremely hard to predict and time markets. Like I don't know what would I be doing now, knowing what's going on, thinking about the future. Energy prices, you think, are going to continue going up? Would you make a play by buying energy stocks potentially? Interest rates are going up. But they've already seen a rise in the last 2 months already. Have you missed that? I don't know.
So to keep it balanced.
I'm more of a financial planner than a wealth manager. Sure. I don't know. What do you think?
For a person that works in the markets, I'm about as risk averse as it gets. I mean, occasionally I used to phone you up and say, "Oh, is now a time to go aggressive, or is now a time to go defensive?" But I think I've agreed that playing the long game and just looking at a chart is going to serve me better, unless I'm trading it all day, every day. In terms of sort of the financial planning element of it, we're talking recently about how you can just be as efficient as possible. And one of the things that we were talking about was sort of the EIS and the VCT schemes that are out there. For those that haven't come across those, what's the sort of the headline there, and what's the rationale for using them? Because I mean, we are a few weeks away from the end of the financial year, and if there is surplus cash, in someone's pocket, is that a place to potentially look at putting it?
Yeah, potentially. If you want something that's a bit more exciting, it's probably going to be more risky than your conventional portfolio, then the EIS VCT space might be exciting to that person. I think, like with everything, so with an EIS, an enterprise investment scheme, you're locking away your money for potentially 3 years if you want to get the income tax relief when you go in. So the way it works is you're investing into early stage companies, very early stage companies. Let's say you're investing £10,000 for argument's sake, you get a 30% income tax relief credit. So you can offset that against your income tax bill for that tax year, for example. VCT, very similar. You invest £10,000, you get £3,000 knocked off your tax bill, but you then have to hold that for 5 years to get the income tax relief. So once again, if you think you're going to need that money in a 3 or 5 year period, probably the wrong thing to do, because if you take the money out, you're losing that income tax credit that you got at the beginning.
Right.
But yeah, it is the more exciting side of it. Yeah.
And when it's exciting and inherently more risky, why is that?
So EIS is far more early stage companies. They're pretty much when I say just launched, very early stage. I think if you invest into an EIS portfolio of, let's say, 10 to 15 shares, I'd be very surprised if all of them were successful. I think you'd expect some to just fall by the wayside and be worth nothing. Some will go on to potentially be successful, and some probably will just tick along. I think, like with anything, it comes down to the people you're choosing to pick these EIS investments.
Yeah.
The VCT side, it's slightly more mature, so you can invest into a portfolio of, let's say, 25 to 30 shares that qualify for VCT status, and they're slightly more mature. So there's less risk involved with the VCT stage.
But the lockup is longer.
Lockup's longer
in a VCT.
Yeah. Right. And also you get dividends paid out tax free as well in VCTs, which is nice. Right.
Do you have to get out at the end of 5 years?
You don't. You can stay invested. But what we do with a lot of clients is essentially after 5 years, you've ticked that box to make sure you get the income tax relief. What you can then do, you can then sell out of, let's say, that VCT, get your money back, and then reinvest it into another VCT and get your tax relief again.
Right, okay.
So, yes, you can stay in it, but it may be more tax efficient to take the money out and then put it into something else.
Sure. No, it makes sense. And just with tax efficiency as well, we've got, I think, a government NI hike coming in next month. Do you think they're going to do it? Or do you think the pressure's going to be on?
I think it's happening.
We sure?
It?
I think there's always an 11th hour public opinion shift that could change it, but
I think it's happening.
It's bolted on.
Yeah.
Wow. Okay.
And I guess the way to, how would you combat that? You want to, I guess, pay yourself less income if possible. So you're paying less national insurance contributions. If you can put more money into your pension so it doesn't get paid out to you as a worker, as an employee, then that'll be more tax efficient from a national insurance perspective.
Yep.
Yeah.
Okay, plenty of things to go on there. Any sort of final thoughts on how someone would navigate the times ahead, or any sort of Jamie's top tips that we haven't yet covered?
I think just kind of like brace yourself for a rise in inflation. I think everyone's feeling it already. I don't think it's going to go away. If you can, try and build up a little bit of a cash buffer. So let's say, assuming, I don't know, if someone's was living month to month 3, 4, 5 months ago, assuming that there's been no change in salary and they haven't received a salary increase, in real terms, you're probably going to be struggling, and you're probably going to have to be dipping into cash. So we always say, if you can keep some kind of cash buffer, that helps. Any other top tips? All the standard financial planning, like make sure you use your pension if you can. And once again, you're not going to be needing to touch it until you're in your 60s, let's say, because that's really, really tax efficient to put money into your pension.
Yeah, and the magic formula of compound interest as well.
And if you're earning over £100,000, it gets really tax efficient to use your pension, because you start to lose your personal allowance once you start earning £100,000 and over. So it's a really high tax band there between, let's say, £100,000 and £125,000.
Right. No, good to know. Well, I think the message is, don't take anything for chance. Be prudent about it, and we'll see where we go, won't we?
Yeah.
Watch this space. Yeah. Next time we chat, hopefully Ukraine has been resolved, and
yeah, I hope so.
Yeah,
I hope so. But hopefully it doesn't spread any further, and it just gets sorted out as quick as possible.
Yeah, I mean, this is a separate conversation I think we'll do once the cameras have stopped rolling, but appreciate you coming on and have a chat, and we'll leave it there.
Thank you for having me.